Let's talk about a little LQD, the liquid investment grade corporate bond ETF. This video, I'm going to be talking about the government's new tricky bailout plan by buying corporate bonds instead of directly bailing companies out. This is Brian Lewis with MMT Investing, and things just changed. So there's three kind of big corporate bond ETFs that I want to take a look at. We get the LQD. These are the investment grade, the corporate bonds of good companies that have lower risk. And then there's the JNK junk bonds, and these have higher risk and higher yields. And there is the HYG. These are also these are junk bonds. These are high yields. So these two are high yields. HYG is like high yield grade, I guess, and JNK is junk bond. These are the riskier corporate bonds, and LQD is the safer investment grade bonds that have good ratings. And this is the chart for the LQD right here. And let's take a look at this thing because it is pretty interesting. So it went from 130 to 100. Okay, so it looked really dramatic, but it doesn't quite fall as far as I thought. And we got the down move. And this is a ABC corrective wave down on the S&P. And then the S&P, we got a 1, 2, 3, 4, 5 wave up. And then we got a little turnover here. So what we are looking at here is the investment grade corporate bonds got kind of held up from crashing, and then they shot up crazy, and then a little less crazy, and then much less crazy here. Now, this is pretty interesting. I don't know why they just kind of stayed here, but they got almost back up to their highs. And so this is going to be an interesting one to look at. It's not really going down with the down move, and it hasn't been going up with sort of the double top that we got on the rest of the market. I looked at these junk bonds earlier when they were going up like this, and I was like, oh, wow, these things are shooting off. But it's only, 130, 107. I mean, a lot of things went farther than 50% down, and these did bounce really high. So, I mean, looking through the cycle, if we get a down move here and we get, another a dead cat, bull trap kind of thing, like these are an interesting one to look at on the way up. I was more interested in them the last time I looked. I thought the chart was a little steeper than this. Probably don't care about these that much. Just based on the chart, on the up moves, it's kind of a swing trading play on the up moves that might be interesting, but this makes it less interesting now that they're acting weird. But that's not what I wanted to talk about this video. I want to talk about what the government is doing with these corporate bonds and the bailouts. And I just did a Boeing video, and this completely ties into what Boeing did instead of taking a bailout. And I just wanted to look at the chart and just sort of chat about it. And that's because the LQD always smashes that like button right now to help me out with the YouTube algorithm. Thank you so much. And this is what's going on. The Fed, Trump, and the Fed, the Federal Reserve Bank of America, they are buying up corporate bonds willy-nilly on the balance sheet, and this is creating a lot of liquidity in the private markets. And what that's doing is, instead of directly bailing out these companies, now the companies can go out and they can find private funding, and that's what Boeing just did. Boeing asked for a bailout, the Fed said yes, and then the Fed bought enough corporate bonds to free up enough liquidity for Boeing to go out and get private funding, and then Boeing turned down the bailout and just did private funding. So as of right now, Boeing's not bailed out. I just did that video and looked at their stock and how that's going to look coming up in the cycle. And Yeah, these corporate bonds are a huge thing in this cycle, in this crash, and the whole bailout situation and the whole Fed blowing up the stock market situation is a huge thing here. And you can see that these corporate bonds are bad, and a lot of the investment grade bonds are getting downgraded to junk status, and now we're jumping up, and this out of all the stock charts that I've looked at is where the Fed is actually directly intervening and pumping the market up, is these corporate bonds. The Fed is buying these and is putting a floor on them when they should be falling, and the Fed can stop these from falling, and they are doing that. They're buying them up now, and that might be what all this nonsense is. A weird looking chart. And so that seems like the Fed's favorite way and Trump's favorite way of sort of bailing out the companies right now, is to just buy up as many corporate bonds as they need to free up liquidity so the companies can get private lending, and they don't need a direct government bailout. And I think that's better, much better than a government bailout, because if the Fed just takes the companies, like the Fed is, well, for one, is not supposed to buy stocks. So if the Fed is actually starts buying stocks directly, that's a violation of like the Federal Reserve Act and what they're supposed to be doing, but they may do that anyway. But the Fed can give bailouts to companies, which is just give them enough loans directly from the Fed for them to keep paying on their current debts. And those bailouts come with restrictions, and they prevent the companies from doing stock buybacks, and then they have to do whatever the Fed and the government tells them to do while they're under the bailout loans. Companies don't want to take those loans, and if they do these corporate bond buying and companies can get private funding, then all of the private sector, the private sector banks are going to do risk analysis, and that's going to be a much more reasonable loan than a Fed loan with whatever interest rate they set, that they can just roll over, and it ends up just being on the Fed's balance sheet, and it's a loan that really never gets paid back until the company goes out of business, and then the Fed's holding all this junk on their sheet. And um, yeah, so that's what the big move is that they're doing right now. It's just buying corporate bonds. They're not buying stocks yet, or they're not supposed to be. And I guess just a little chat about kind of the Fed intervening in the market, and everyone thinks the Fed's pumping the market up. I've said this a bunch of times, but the Fed is not blowing up the stock market right now. Like what was happening on the way up here in this bull market is the Fed liquidity and loans was loose, and the companies had more money than they needed in loans, and they weren't profitable, and they were just using all the extra liquidity to buy their own shares back. And that was kind of a dumb move from the corporations to be buying back shares when they're at an overpriced valuation. That's not good for the company. And yeah, and then you get this situation where you get this credit contraction, and now the money's tight, and people don't have money to be doing stock buybacks with now. Now their debt and their profit margins and everything are tight, and so fundamentally, no one else, the companies can't do stock buybacks right now, or most of them can't. I mean, I think Google just did a round of stock buybacks recently, and they have the cash flow to do it, but not a whole lot of companies do. And what uh, what happens is, well, I mean, like with the stock buybacks, Warren Buffett was talking all about the stock buybacks this week, and he's like, it's not immoral to do stock buybacks. It's kind of just a way to pay shareholders without doing like dividends that have taxes. If you do stock buybacks, it gives the shareholders higher value. But he's like, if you do stock buybacks when the valuation is really high, that's just dumb. Like you need to do stock buybacks when the stock is down at a low value, and you're buying back your company shares at a good value, and you're helping the shareholders, and they don't have to pay taxes on that. It's like a speculative gain without like dividends and taxes and stuff like that. So Warren Buffett thinks stock buybacks are fine, but it's just really dumb to do them at high valuations like the companies are doing now. But what most people are saying is companies that are doing stock buybacks at high valuations are intentionally doing that, and then they're just like paying out the CEOs with that extra money and giving them shares and stuff like that, and it's increasing the share prices. And that's why you see the share prices going up, because the stock buybacks directly make them go up. Um, but when you get into this credit contraction and a crash, companies don't have the ability to do stock buybacks, and now it's kind of become politically incorrect thing. Like you're not supposed to talk about stock buybacks now. It's not okay anymore. And the government is coming out and directly saying, pointing out companies doing stock buybacks and saying it's bad, making a big deal about it. And now the government bailout loans that they're offering are starting to come with the stipulation that if you take this bailout loan, like you cannot do stock buybacks with it. Trump came out with a tweet just recently. He's like, if we're going to do these bailout loans and we give companies this money, like I don't want them going and spending this bailout money on stock buybacks. He's just like coming out and saying that now, and he's not the one giving those loans or stipulating any of this stuff that's coming from Congress and the Fed. But he's the one tweeting it, and that is the situation right now. And I was wondering if these corporate bonds would be an interesting thing to buy at any point during this cycle, because it looked like they made a big move up on the last up move, but now they're weird. And yeah, I don't know what to do. I don't know what to do with the corporate bonds because, well, and then if you look at the high yield and the junk bond ETFs, they didn't bounce quite as high as these investment grade, the LQD investment grade. But um, yeah, this is one ETF that the Fed is directly pumping up and putting a floor on and buying. And this here, we could actually see kind of a floor where this thing doesn't come down when a lot of other things do come down. And then do they go up after that? Or I don't know. I don't know how to trade these right now. I mean, these things are so risky, all of these, even the investment grade, because these companies, if they start getting in trouble, you have to delist these these bonds out of the investment grade, and then you have this ETF, and who knows, you could get like contango in the corporate bond ETFs like we saw in oil. So I mean, if you're gonna get a long squeeze and a contango kind of thing in these, then that you could short into that. But or the Fed just completely backstops them and they never go down. Or this is one where the Fed's intervening, actually is intervening, and it's just really, really hard to predict what this graph is going to look like. I mean, it's just like has taken a break from following the cycle that everything else is following, and it's doing its own little thing here. So, I mean, that was the idea of this video. It's just kind of to chat about the Fed is not blowing up stocks in general right now. In fact, they're saying that the thing that was blowing up stocks is bad and everyone needs to stop doing it. And they're not only saying it, anyone they're giving loans and bailouts to is legally prevented from doing that. So really the stock market being propped up and pumped up by the Fed is that's just straight up not happening right now. And what we have now, instead of this kind of inflationary liquidity, is we have a worldwide credit contraction where there's less money, and then you see where the new money is going. It's not going to corporations and stock buybacks. That's not where it's going. It's going to small companies. It's going directly to individuals, and that's a small percentage of the money. But right now, and this is not investment advice or political advice or whatever, but right now, you can't see exactly where it's going, but you know where it's going. Like this money, they're bailing out the entire Eurodollar system. The international banking system is collapsing, is screwing up, and there's no liquidity, and there's all these international loans. and nobody can pay them, and everyone's trading in all their local currencies to get enough dollars to pay the loans. It's a huge shortage of dollars across the whole world, and the Fed is pumping. That's where that balance sheet money is going. The Fed is pumping money out to all these international banks, and they're making all these programs to get money directly to anyone that has to pay on the loans so that the banks don't go bankrupt. I mean, the banks have balance sheets; they have to get the loan payments, or else they go bankrupt. And that's what the Fed is doing, reconnecting this whole system that's kind of got disconnected from the Fed, and they kind of went off and created way too much money, and now we get this credit contraction cycle, and it's a huge worldwide problem. And that's where the Fed money, that their balance sheet, you can go to the Fed website and look at their balance sheet, and it looks absolutely crazy, like $5-6 trillion, and people are just like, oh my god, this number is insane. But it's not that crazy if you know the actual numbers in the worldwide system. So, like, Luke Groman has been talking about this a lot the last couple of weeks, and he was saying something like there's like $47 trillion of non-financial debt inside the USA, and that's like loans that all the companies here owe on. And then outside of the USA, the international banks in the Eurodollar system, the US dollars loaned internationally is more than that. It's 57 trillion or higher. And so it's over $100 trillion of loans that people have to pay on across the entire world. It's over 100 trillion. And right now it's a dollar squeeze and a monetary contraction. So it's deflation. We're losing dollars. Companies can't pay the loans, and that 6 trillion is not an insanely huge number compared to 100+ trillion that is shrinking. They're just trying to battle this contraction and the deflation, and like, if you talk to, well, not talk to them, but listen to Jeff Snyder and Luke Groman, and look at the Eurodollar system, and this is I mean, they're saying that the Fed is being really cautious and probably under providing because they're scared of inflation, and they you know they don't know how much to do. They're kind of just taking shots in the dark, and they don't really have the connections to send it where it needs to go. So they're just kind of trying to connect things and trying to send some money, but it's a mess. It's a mess right now. And that's really where the bailout money is going, to the international banking system. You talk about like Deutsche Bank and HSBC are these banks that are in a whole lot of trouble right now. And I should probably mention the GLD along with HSBC, because the GLD, people think it's safe and people think it's gold, but the GLD is a contract from HSBC, which is one of these international banks that is in super trouble. That's the custodian of the GLD. So if you're if you're holding on to GLD and you think it's safe and it's gold, it's not. It's a piece of paper that is held by HSBC, and if they go bad, GLD goes bad, and they can do whatever they want with those holdings. They can keep them or whatever. Who knows what'll happen? And is the Fed going to do some crazy huge bailout move internationally to HSBC to help everybody's GLD holdings? I don't know about all of that. So that's just a look at the whole Eurodollar system, and that is what is actually our world reserve currency right now. Like the Fed, we used to have a gold-backed Fed dollar as our world reserve currency as of like Bretton Woods 1944. It was a gold-backed Fed dollar, and that ended in like 66. Like, and then 71, they took the gold backing off. Nixon closed the gold window and took the gold backing off, but it's switched from that Fed gold-backed dollar to this international Eurodollar system, where the international banks are providing all the dollar loans in the 60s, and then around the 80s, it really took off, and that is really where the everything bubble took off. It was around 82 when we finally came all the way down off of the the US gold-backed dollar bubble, and the euro dollar really took off, and that this whole everything bubble is the euro dollar bubble, and it's backed by oil like petrodollar, and it's backed by corporate bonds. You got like the NASDAQ corporate crash, and then it's backed by mortgage-backed securities. You got the housing crisis, mortgage-backed security collapse, and the financial crisis, and that's all the things that are backing this international system. And now we're looking at all these bonds, and these corporate bonds are going bad, and the Fed is buying them up, and mortgage-backed securities haven't started to look too scary yet, but they started pumping a bunch of mortgage-backed securities into the repo markets again, like they were doing in the financial crisis. That looks really bad. And then obviously oil is just on the ground. Like oil is awful right now, and that's the whole backing of our entire monetary system, and we got this contraction going. So the Fed is pretty limited, really, is what I'm trying to get at. And they're not pumping up the stock market. And people that are buying things at crazy valuations, thinking the Fed is going to pump this thing up forever is, well, I'm not going to say it's not going to happen because I don't know what's going to happen, but it seems highly unlikely that the Fed is, especially during this cycle, this credit contraction cycle that we're in right now, is going to be able to pump the stock market to all-time highs right now, and they don't even have connections to get money to the international banks they're trying to get money to. So yeah, they opened a new repo market. The repo market's where the banks trade collateral and liquidity back and forth, and the international banks couldn't even get money out of our repo market because everybody's holding their treasuries and their collateral and not loaning money. So the Fed opened a new repo market called FEMA that directly services these international banks. They're just bailing out the Eurodollar system. Like that's what's happening. And that's where we are in this market. And that's what modern monetary theory and MMT is. It's this new system. They're trying to reconnect and send helicopter money and direct money to different places. And it's crazy. It's just straight up crazy. And that's what we're investing in here. And this contraction right here is why I have my shorts on this week and just holding dollars. I mean, dollars look okay for now, and then if inflation starts kicking up at some point, the dollars don't look so good. So that's too much. That's a lot. Please hit the like button and subscribe or whatever. This is not investment advice. All right, cool. Corporate bonds. That's what's up. Happy trading.